Should I invest more in my 401k? So in this video, we will cover when you might want to invest more in your 401k, when you do invest more, how to tier those additional investment contributions, and how to plan for taxes now and in the future, and a case study with numbers to support when you should or should not be investing more in your 401k, and a bonus step-by-step framework for deciding your next best move when it comes to investing more. Hi, I'm André, a certified financial planner, and I take a thoughtful approach not only to investing, but to making sure my clients' overall financial life supports their goals of financial freedom. You are earning a good income, saving, investing, and you ask yourself, should I invest more in my 401k? If you are considering that question, this video is for you. So let's walk through when increasing your 401k makes sense and when it doesn't, and how to integrate it into a smart, tax-efficient strategy that fits your goals. Let's start with a scenario. Imagine you're 41 years old, earning about $141,000 per year. You've already saved $275,000 in your 401k. You've got a house with a low interest rate, and you're contributing 5% to your employer 401k and maybe a Roth 401k with a 5% employer match. You're also maxing out your Roth IRA contribution annually. And here's the question: should you invest more up towards the annual maximum into your 401k? That's exactly the type of question many high earners face. The short answer is yes, possibly, but only if it aligns with your goals, your values, and overall plan. So this is not just a blind yes, go and do it, but let's evaluate that question step by step. So what are you optimizing for? Before you increase your 401k contributions, take a minute and ask, what am I doing this for? Are you optimizing for minimizing your taxes today? Are you looking for flexibility and possible early retirement? Or are you looking for a longer term outlook? So legacy planning and future financial freedom, or maybe even an investment account for your child. So when you know your why, your decision becomes much clearer. For example, if you want to retire at 60 or earlier, you'll want some accessible assets, some tax-deferred buckets, and not just a giant 401k you probably won't touch until you're 59 and a half or older. So remember, save more is good, most certainly, but tax-efficient saving is better. So what are you actually optimizing for and saving for in your 401k? Let me know in the comments. Understand your 401k options. Let's review what your 401k actually offers and what you need to know. Contribution limits for 2025 for most of us is $23,500 for regular contributions, and if you're 50 or older, you get to add the catch-up contribution for a $31,000 total contribution. And for 2026, you can make a $24,500 total contribution to your 401k. And for those 50 and better, can make a $8,000 contribution in 2026. And then also, don't forget, if you're age 60 to 63, you can make a total catch-up contribution of $11,250. Now let's talk about traditional versus Roth. Does your employer plan offer both? If you contribute to a traditional IRA, you get a tax deduction. Roth means potential tax-free later. If you expect to be in a higher tax bracket in retirement, Roth often wins, but if you're in a high tax bracket now, you might lean towards pre-tax contributions to reduce taxes. Employer match. If your employer matches 5%, that's something like free money. It's rare that I would mention not to get the full employer match. But once you have captured the match, you still need to evaluate, is it best to push more into the 401k plan? So keep this in mind. investment options, and fees. Not all 401k plans are equal. Some have high fees or limited fund choices. But if your plan is not particularly advantageous, you may look beyond increasing your investment in your 401k. Now, when it makes sense to contribute more, here are some of the conditions when increasing your contributions typically makes sense. You're in a high tax bracket today, so your pre-tax contributions move meaningful dollars off of your taxable income. You've already maxed out your tax advantaged accounts, so your Roth IRA, your HSA, and maybe even a 529 for your kids. Your employer plan offers low cost, diversified funds, and a straightforward platform. You're fine staying within those offered investment choices. You want automatic investing and discipline. Payroll deductions means you don't miss the money. You're planning to retire at 60 or maybe earlier, and you have a pathway for withdrawals. What I mean by this is you have strategies for a Roth conversion ladder and plans to move to tax-free income from your taxable account. When those boxes are checked, moving from, say, a 5% contribution to a 10% contribution, or even pushing towards a maximum, can meaningfully increase your projected retirement savings. So now, when you might not want to contribute more to your 401k, there are equally valid situations where you should pause or slow increasing your 401k contributions. Some of these reasons are: you need liquidity for short or midterm goals, funding a home remodel, starting a business, paying for education, or building a taxable investment account. Your plan is limited and or costly, so high fees, fund lineup that does not support your additional investing goals, and restricted investment choices. You're overweighted in pre-tax assets, so you have too many of your overall portfolio assets in pre-tax accounts like 401ks or traditional IRAs. If almost everything is tax deferred, you'll face large tax bills in retirement. That tax diversification does help now and in the future. You expect to be in a higher tax bracket later, maybe due to business income, pension, or other streams of income. It may make sense to lean more into a Roth or taxable accounts now. You have other goals such as building an investment account for your child, funding legacy or philanthropic goals, or balancing retirement with family wealth planning. So now let's consider a tiered investment approach. So here's how I recommend you think of your savings in tiers. So first, short term. This is 0 to 3 years. Cash, high yield savings accounts, emergency funds. If you need flexibility, this is your foundation. And then midterm. So we're looking from 3 years to 10 years. This is mostly your taxable brokerage accounts. Also perhaps specialized accounts for education or legacy planning. And these do have some accessibility, but then it's also flexible. And then long term. So long term, we're looking 10 years and out. So 10 years plus. So this will be your 401ks, your IRAs, your pensions, designed for retirement and those long-term goals. When you invest in only one tier, say just your 401k, you risk being locked in or unbalanced. So by layering, you build in both flexibility and long-term spending power. Tax diversification and future flexibility. For high-earning professionals, one of our greatest risks in the market is future tax policy and your own tax bracket. That's why tax diversification is important for planning your retirement. You want a mix of pre-tax assets, traditional 401k, traditional IRA, Roth assets, Roth 401k, Roth IRA, taxable assets, brokerage accounts, trusts, and investment accounts for your child, potentially. This mix gives you options. You can decide which bucket to draw from in retirement based on what makes sense, what your needs are. Make sure in this that we're planning for doing this in a tax-wise manner lifestyle-wise, and legacy-wise. If all you have is a pre-tax 401k, you have fewer choices and not less risk. How to evaluate your plan. Before you increase your contribution, ask these questions. What are the expense ratios, fees, and hidden costs in the plan? Are the available funds diversified across U.S., international, bonds, and cash? Does the plan allow a brokerage trading option or give you flexibility? How often is your plan reviewed by a dedicated financial professional? And do you get annual reviews, updates, or input on the progress to your goals? If I leverage this plan, how does it fit with my other accounts? IRA, taxable, 529s, and custodial accounts. If you're not sure about your answers to these questions, that's a sign you might want to have a review from a financial professional. So as I discussed in How Much Does a Financial Planner Cost? You can see the link to that article here. You can learn more about how a meeting with a CFP can reveal the areas that you are doing great in, areas that you need additional focus, and the ways to align what you value most about your money with a plan that supports you. Now let's talk about a real world scenario and the numbers that support that. So let's revisit our initial situation. A 41-year-old that makes $141,000 salary makes a 5% contribution plus a 5% employer match to their 401k. Suppose we boost that to 10%, just as an example. So this means turning roughly $14,100 annual contribution into about $21,150. If this extra $7,050 annually grows about 7% for 19 years, so until the age of 60, so this person could accumulate about $264,000 in additional dollars above the company match and their original contribution. And that's a meaningful change. So who wouldn't want to have $250,000 extra? However, let's consider this because this is important. That projection assumes solid investment returns. The plan has good funds, and we haven't factored taxes, liquidity needs, or other goals into that. So your decision isn't just about how much more to contribute to your 401k. It's about, does this belong in my overall strategy? Now let's talk about the step-by-step framework for deciding to invest more in your 401k. So number one, clarify your retirement age and lifestyle. Will you aim for 60, 55, 65? Review your current tax situation and future income expectations. And then 3, assess your short-term and mid-term cash and liquidity needs. So that's that 0 to 10-year time frame. And then number 4, evaluate your current 401k plan, the funds, the fees, and flexibility. And number 5, determine whether increasing contribution aligns with your goals and other accounts. Number 6, consider speaking with a CFP to model different contribution levels and tax outcomes. And then number 7, revisit often. Your situation changes, tax laws change, and the plan most certainly needs to be updated. Now let's put this all together. Contributing more to your employer 401k can be a smart move, but it should be intentional. This ties into your broader tax strategy, your liquidity needs, and your long-term goals. At A Small Investment, I work with people just like you to build a plan that considers every piece: your 401k, your IRAs, your tax brokerage, investment accounts, your children and personal, as well as legacy planning. If you're wondering whether you should increase your 401k contributions, let's talk. Book a values-based meeting and let's make sure every dollar works hard for you. And if you found this video helpful, please hit the like button and subscribe for more insights, and click the notification bell so you don't miss future videos. See you in the next video.